welcome to the last edition of Indianomics for the year 2015. It has been actually a satisfying year for India's macroeconomy. From a nearly 10% average inflation in 2014, CPI came down to average 5% in 2015. The current account deficit, which in 2013 and 14 were around that 5% mark, fell to around 1.5% in 2015. Growth stayed above 7%, in fact, a few 20-30 basis points above the previous year, 2014. So, what about 2016? Three veteran watchers of the economy joined me. Dr. Rakesh Mohan, former Deputy Governor of the Reserve Bank of India, Samiran Chakraborty, Chief Economist, Citibank, and Anada, Bhoumik, the Chief Analytical Officer at India Ratings. Gentlemen, thank you very much for joining me. First, let me start with you, Dr. Mohan. Since you have just worn your hat in the IMF as a representative of India and the adjoining countries, what is the sense you're getting of the global economy? Will it once again be anemic and be a hindrance to Indian growth?
The prospects for 2016 are more uncertain than I think they've ever been in recent years. On the one hand, you have a reasonably constant US recovery. There's also expectation of Europe doing a better recovery in 2016 than they have done in the last couple of years. Japan remains a question mark. On the emerging market side, India is clearly continuous recovery. Brazil and Russia are question marks, although the IMF does expect improvement in both of those countries, which have indeed recorded recessions in 2015. And China, of course, is the biggest question mark in the sense that, of course, it will continue growing at a high pace, at between 6 and 7% as of current expectations. So, as you mentioned, the IMF forecast for 2016 for the global economy is 3.6% as compared to 3.1% for 2015. And in that, for the advanced economy is 2% 2015, 2.2% 2016. A higher, better improvement for the emerging markets from 4% to 4.5%. Now, having said that, there are also some doubts that some observers have. Not, I should say, the IMF, but some observers do have some doubts about the US economy recovering on a continuous basis, because recovery has indeed been going on for a significant period of time, which is already longer than most recovery periods recorded for the US economy. So there are some observers who are saying that the recovery is now aged and it might well peter out. So now in that context, the other main source of uncertainty is that the US Fed has, of course, started its normalization process with the 0.25% increase last week. The expectation is that they will increase by 100 basis points over 2016. But the question remains that if indeed the US recovery is not as robust as is currently expected by the US Fed, will they again pause?
Yes, clearly there are still question marks over the two big economies, US and China. But Samiran, you know, the global economy is what let down India in a sense. The domestic economy at least was better than the previous year. How about 2016? Should we expect the globe to be a help or a hindrance?
Well, our view is that probably the global economy remains on a slowish pace for another year. And if that's the case, then the external headwinds are going to remain for India. The positive side for India is that we are seeing some early signs of a cyclical pickup. So if some of the structural reforms are put in place over the course of 2016, or for that matter, some of the things which already happened in 2015, we could see the lagged impact of that in 2016. So if these cyclical factors and the structural factors are put into place, then probably we will be able to counter the external headwinds better in 2016, and that's why we have taken a view that growth will possibly be marginally higher in 2016 compared to 2015. Having said that, the difference in our growth rate estimates are so marginal that it could be almost imperceptible in terms of its actual feeling. And that's why we have to be going through this process of deleveraging we are in the middle of now for a considerable period of time before we can move into structurally a higher growth path. If you look at it, today we are in an uneven growth path where public investment and urban consumption are two drivers of growth, whereas private investment and rural demand seems to be the ones which are facing headwinds.
Yes.
So if we want to burst on all four cylinders, then clearly deleveraging has to help the private investment side.
No, I mean, I completely agree, and that's why I have the ratings guy, Anada Bhoumik, on that issue of deleveraging. But I'll come to that in just a bit. Dr. Mohan, fiscal deficit. The mid-year review gave the impression that, that the only way to kickstart growth would be to increase fiscal deficit. Two questions. One, is that a good argument? And two, what's your sense? Will we do 3.6 or 3.9 fiscal deficit in the next year?
Well, I think that what is important to look at is that if we do increase the fiscal deficit or keep it the same, will it be through public consumption or public investment? I would clearly say that we should completely desist from not reducing the fiscal deficit if it is because of public consumption increase. However, I think that if indeed we can step up public investment, both in the railways in particular, also in other aspects of public investment, then I think that we could possibly consider slowing down the path of fiscal consolidation.
Well, my bigger problem is that this year's 5.5 lakh crore of bonds are finding not enough buyers, and even after 125 basis points of rate cut from the Reserve Bank, the 10-year stands stubbornly at that 7.8% mark because the appetite is quite clearly dwindling. Well, Samiran, first a very quick answer on whether you think the market can absorb a 3.94% deficit even if it were for investment, and then what will be the impact on inflation?
Well, the problem with this year's fiscal arithmetic is that it starts off with 0.3 to 0.4% of GDP additional spending on public consumption because of the pay commission effect. So to neutralize that public consumption and keep on raising public investment, it's a tough balancing act between having the fiscal credibility versus some kind of a fiscal stimulus into the economy. We have to keep in mind that last year also we had pushed the fiscal targets by 1 year. So if on 2 consecutive years we kind of veer away from the fiscal path, then it could have some implications from the rating agency perspectives. Having said that, the critical part is on its impact on inflation and the bond market. I think on the inflation part, as long as the investment component is relatively higher compared to the consumption component, we should be more or less okay. My bigger worry is on the bond market side, where not only will the net supply of bonds go up because of 3.5 becoming 3.8 or 3.9, but also we have to keep in mind that next year we have a very large 2,25,000 crores of redemptions, increasing the gross supply substantially. And what we are seeing today is that if that gross supply comes at the longer end of the curve, then we could see significant curve steepening happening, which we have already seen over the last few months. And this steepening of the yield curve at a time when growth is already facing headwinds could in fact become counterproductive.
Okay. Well, actually, I want to get to inflation very quickly. I'm being told I have to take a break. But we are back, and I want to check out how much of interest rate cuts our experts are expecting and how much our banking expert expects the banking system can pass on. The banking piece will be very important for the macroeconomy. Those questions in a minute with our experts.